Crypto promised to replace banks. Stablecoins almost did. Governments noticed and panicked. Honestly, what a quote to start us off. Because on one side of the fence, you have millions of people finally discovering a frictionless way to move their money around. But on the other, you've got sovereign nations suddenly realizing that their absolute control over currency is quite literally slipping through their fingers.
Welcome to The Explainer. I am thrilled you're here with us today. We are going to be breaking down a massive, real-time collision between crypto's true killer app, the digital dollar, and global financial regulators who are currently scrambling to rewrite the rules of money. We're going to look strictly at the facts and the data to see exactly how these digital dollars are forcing a global regulatory war.
Okay, let's dive right into this. Our roadmap today is crystal clear. We'll start off by meeting the digital dollar and looking at the billions that seemingly vanished. Then, we'll contrast Europe's new laws with the American regulatory chaos, take a look at the global patchwork, and finally, give you a playbook on how to survive these new global rules.
So to understand the panic, we first need to understand the product. Section 1. Meet the digital dollar, crypto's killer app. Now, a stablecoin looks incredibly simple on the surface, right? One token equals one US dollar. Functionally, though, it's actually three entirely different things all wrapped into one. First, it's cash that you can send literally anywhere in seconds. Second, it acts just like a bank deposit, but it lives completely outside the government's FDIC insurance safety net. And third, it's a global payment network that completely bypasses legacy rails like SWIFT, Visa, or the Federal Reserve. No government designed this system, and absolutely no government can shut it down with a single phone call.
Let's look at why users actually care about this, because the contrast in pure utility here is staggering. Imagine you want to send $10,000 to China using a traditional bank. Well, that's going to take you around 5 days and cost you $50. But if you do that exact same transaction with a stablecoin, 2 minutes, $1, you don't even need a bank account, just a smartphone and an internet connection. This immense reduction in friction is exactly why millions of users globally have adopted them for payments, savings, and hedging against local inflation.
$8 trillion. Just let that sink in for a second. That is the yearly transaction volume for stablecoins. The total market cap is pushing toward $160 billion. So the absolutely crucial point here is this. Stablecoins aren't just some niche, quirky crypto experiment anymore. They are the first crypto product with genuine, undeniable mass adoption. And because they deal in dollars, which are inherently sovereign, this $8 trillion figure represents a direct, unavoidable challenge to central banks worldwide. Which brings us to Section 2, the billions that vanished. These were the catalysts that gave regulators all the ammunition they needed to step in. Now, what's really interesting here is how the law sees these tokens entirely differently based on what's actually backing them. You have fiat-backed coins like USDC, which basically operate as e-money IOUs. Then you have crypto-backed coins like DAI, backed by automated smart contracts, which are just self-executing lines of code floating in this regulatory gray area. And finally, algorithmic stablecoins, which rely purely on market incentives instead of actual cash reserves. As we'll see in a moment, regulators have effectively declared that last category dead globally.
Watch how this builds into absolute chaos. In May 2022, the algorithmic stablecoin Terra UST completely collapsed, evaporating $40 billion in a matter of days. $40 billion! This proved to regulators that unbacked algorithmic coins carry massive systemic collapse risk. But fiat-backed coins, well, they aren't immune either. In March 2023, Silicon Valley Bank failed, trapping $3.3 billion of Circle's USDC reserves. Literally the very next day, USCD pegged down to 88 cents, which triggered a massive bank run. We're talking $3 billion in redemptions in just 24 hours. Turns out, fiat-backed coins basically carry traditional bank run risk.
So, how did the authorities respond? Section 3. Europe lays down the law, creating the MiCA precedent.
Under the EU's new MiCA framework, stablecoins essentially have to wear a bank suit. If you're an e-money token or EMT, you must be pegged to one fiat currency, have strict one-to-one reserves, you cannot pay interest to holders, and you practically need a bank or e-money license just to issue it. The alternative is an asset reference token, backed by a basket of assets, but that faces incredibly strict approval requirements from the European Central Bank. This whole framework requires a minimum of 350,000 euros in capital and intense audits. It's effectively killing off small crypto startups because only the massive players can actually afford to survive this.
And then there's this wild number, 200 million euros. This is a daily transaction cap placed on any non-EU stablecoin. Why does that matter to us? Because it quietly, but effectively, targets dollar-backed giants like USDT. It is a deliberate, calculated policy designed by the EU to curb the dominance of the US dollar in Europe and actively push the market toward euro-backed stablecoins. And honestly, according to the data, it's working. Euro stables are up fivefold.
Let's cross the Atlantic now for Section 4, American regulatory chaos, and the massive vacuum it left behind. So, without a dedicated stablecoin law like the 1933 Securities Act or the 1863 National Bank Act to guide them, U.S. regulators have basically just resorted to lawsuits. Take this quote from SEC Chair Gary Gensler: "Most stables are securities." Operating on that theory, the SEC issued a Wells Notice, which is a formal warning of impending legal action against Paxos in early 2023. The result? Paxos simply threw their hands up, stopped minting, and $16 billion in the BUSD stablecoin was wound down. This massive market freeze happened without a single court ruling. Talk about sending a chill through the U.S. market, right? And this brilliantly illustrates what the industry is calling Operation Chokepoint 2.0. Think about it. Crypto-friendly banks were shut down. Stablecoin issuers lost their essential banking access. On top of that, the Federal Reserve is actively denying them master accounts, which strips away their direct access to the central bank, forcing them to push their reserve management to traditional financial giants like BlackRock. The message here is stark, guys. The U.S. government might not be passing laws to explicitly ban stablecoins, but they are systematically debanking the entire industry.
Section 5, the global patchwork. Let's zoom out to see the world's reactions.
It's really fascinating to impartially compare how different sovereign nations are reacting to this tension between state control and civilian demand. Nigeria's central bank outright blamed USDT for the collapse of the Naira, banning peer-to-peer platforms, though on the ground, citizens still heavily rely on it through private over-the-counter desks. China went with the ban and replace strategy, outlawing crypto entirely while pushing their own highly traceable central bank digital currency. Meanwhile, Singapore and the UAE are taking the license route, attracting huge businesses by mandating clear one-to-one reserves. And in Latin America, governments generally tolerate them, practically ignoring the usage because citizens desperately need them just to survive local hyperinflation.
So what does this all mean for you? Section 6, How to Survive the Rules, the User Playbook.
Look, the Wild West era of stablecoins is officially over. The compliant era has begun, and here is exactly how you navigate it. Step 1. Diversify. Don't just hold one single token. Spread your holdings across issuers like USDC, DAI, or URC, and across different blockchains to mitigate the risk of sudden freezes. Step 2. Use self-custody wallets like Ledger. Centralized exchanges are now legally forced to comply with these new laws, meaning they absolutely can and will freeze assets. Step 3. Monitor exchange delistings very closely, especially in regions like Europe where MiCA is forcing non-compliant tokens off platforms. And finally, Step 4. Always maintain a reliable off-ramp plan into fiat currency in a jurisdiction that actually remains crypto-friendly.
I want to leave you with this final, kind of provocative thought. As we've seen today, regulators aren't going to outright ban stablecoins globally because, frankly, they are simply too useful. But they are actively forcing them to become licensed, heavily reserved, and freezable banks. So the real question is, when stablecoins are finally forced to become exactly like the banks they originally promised to replace, what happens to the core promise of crypto? Thank you so much for joining me on this explainer. Keep learning, stay focused, and I'll catch you next time.